If I come knocking, it's because your failing business called me.
Hi, everybody. Welcome to On the Money. I'm Maria Bartiromo. Bernanke speaks, the market quakes, what the Fed's new plan means to the market, the economy, and your wallet. My conversation with one of the most powerful people in Washington, John Boehner, on the Fed fiscal policy, the immigration reform, and a lot more. A discussion you don't want to miss. And forget about retirement communities, where baby boomers are headed when they hang up their working shoes, the impact it has on the economy and younger people. On the Money begins right now.
This is America's #1 financial news program, On the Money. Now, Maria Bartiromo.
Here's a look at what's making news as we head into a new week on the Money. Federal Reserve Chairman Ben Bernanke spoke, and the markets had a taper tantrum. Bernanke said because the economy is getting stronger, and if the strong reports continue, the Fed is going to slow down the pace of its bond buying program that helps keep interest rates low this fall. Bernanke also said quantitative easing could end by the middle of next year.
If the incoming data are broadly consistent with this forecast, the committee currently anticipates that it would be appropriate to moderate the monthly pace of purchases later this year. And if the subsequent data remain broadly aligned with our current expectations for the economy, we would continue to reduce the pace of purchases in measured steps through the first half of next year, ending purchases around mid-year.
Well, those words spooked the markets. The Dow Jones Industrial Average tumbled more than 350 points on Thursday. That was the worst day since the presidential election last November. It was the biggest two-day decline of the year as well. The markets were mixed on Friday. And on top of that, interest rates on the benchmark 10-year Treasury bond spiked, interest rates rising above 2.4% during the week. Meanwhile, more strength in the housing market. Existing home sales were up 4.25% in May to an annualized rate of 5.2 million homes sold per year. That's the highest rate since November of '09, and it was better than what analysts were looking for. And Porsche came in first place, not in a race, but in J.D. Power's annual survey of new vehicle quality. Porsche was followed by GMC, Lexus, Infiniti, and Chevrolet. Their owners reporting the fewest problems with their new cars. The worst performers? Scion, Fiat, Mitsubishi, Nissan, and Mini. Ben Bernanke spoke and the markets trembled. It may not have been the reaction the Federal Reserve Chairman had hoped for when he set the stage for tapering the quantitative easing program, probably later this year. Did he do the right thing? Did the markets overreact? And where do we go from here? Joining me right now, former Federal Reserve Vice Chairman and author of the book, After the Music Stopped, Alan Blinder. Also with me is Adam Parker. He's Chief U.S. Equity Strategist at Morgan Stanley. And gentlemen, it is great to have you on the program.
Thanks for having me.
Thank you so much for joining us. So, Alan, the big story of the week, of course, is the Fed. And what Bernanke said after the meeting, that the Fed would begin likely to slow down the bond buying program, that $85 billion of bond buying every month later this year, and perhaps be out of the bond buying business by next year, this time, mid-2014.
Right.
Did that surprise you? Do you think this was the right decision?
It did surprise me because it came a bit earlier. I mean, it's in the large sense, it's not a surprise. They have to go out of this business and indeed not just go out of buying, but start to get into selling at some point. That's not a surprise. But the timing surprised me. I didn't think, he's now set a tacit calendar of starting to sell in September or so and starting to taper, and then finishing by June. That's a very specific calendar, and that surprised me.
Adam, the market's tanked on that. I mean, Alan's right. It was so specific. I was surprised, actually, that he was so specific. But the economy is getting better. I mean, it's interesting. We're tanking, selling off like this on the idea that the Fed's going to start withdrawing the support because the economy is doing better. Why is that a bad story?
Well, it might be the opportunity, but look, there's two things to get the market right. There's the earnings, and they can improve the economy's better. But then there's that multiple, that PE ratio. And this PE ratio is about psychology, and it's influenced by tapering. I think people were worried that the PE ratio expanded a lot, the multiple expanded, because of QE, and if they're going to stop doing it, that they're going to anticipate that it won't be as positive. I think it's a big deal. What we had for the whole entire quarter was good economic news, good for the market. Bad economic news, good for the market because they'll do more QE. And that last thing changed this last week. And what happened now is bad news mightn't be bad for markets because they told you that this QE, that the efficacy is diminishing.
What do you think the economy looks like right now, Alan? What's the state of things?
Yeah. I'm a bit and this is one of the reasons I was surprised by the timing. I'm a bit less optimistic than the Fed forecast. Closer, actually, to the market consensus, which is always a surprise to me but I am now, sort of in the high 2s rather than in the low 3s. Now, that's not a world of difference.
2% growth, economic growth.
Yeah, something in the 2s, yeah, for the balance of this year and for 2014. Now, if you hold that view, the Fed has a more optimistic view, and that's a fundamental linchpin of this calendar. Now, Ben Bernanke, remember, took great pains to say, well, we're going to be flexible, we might go faster, we might go slower, but that's a nuance that markets don't like to hear.
Let me ask you about what happened in the bond market, because, I mean, wow, what outflows, right? In the month of June, we had about $40 billion of money come out of bond funds. So this is the so-called great rotation, money coming out of bonds and going into stocks. Do you think that's going to happen given the level of interest rates at this point, the 10 years creeping up above 2.5%?
So I think there's two kinds of people. I think on the institutional side and the asset allocation side, they may say, well, I think bonds in a medium-term time frame just aren't going to be very good, and I'm better off owning equities in a medium, 3, 4, 5-year view. I think the retail investor, and as you know, at Morgan Stanley, we have the biggest retail network in the world. I think it's hard for them to say, wait a minute, I lost money in absolute terms in my bonds, now I'm going to go buy stocks. I think that's a little bit tougher for them, particularly after they kind of saw their statements in 2008.
So they're going to keep it in cash?
I think they may go more defensive, short duration cash.
The other big story is what President Obama said about Bernanke this week. I got to get your take on this, Alan, because President Obama talked about whether or not the Federal Reserve Chairman would stay past this January when his term is up. He said it this week while speaking to Charlie Rose. Listen to this.
Well, I think Ben Bernanke's done an outstanding job. Ben Bernanke is a little bit like Bob Mueller, the head of the FBI,
yes,
where he's already stayed a lot longer than he wanted or he was supposed to.
Some people think President Obama just fired Bernanke.
Yeah, I wouldn't. No, I've heard that. He didn't fire Bernanke. Bernanke's got a term that ends in January, and first of all, the president can't fire him. But I think what I read that as saying President Obama sort of let out of the bag probably a discussion that he and Bernanke had. But I suppose he told the president something that's not a surprise, which is he'd like to go at the end of his second term. I mean, that's been the working assumption of everybody for a long time.
But do you think Bernanke leaving has a big impact on the markets, Adam?
It could. I mean, the current consensus view is that, Janet Yellen would be the likely replacement, and that's someone who could be even more accommodative or more focused on rates. And so the euphoria about rates backing up right now a ton might get a pause later in the fall if we find out that somebody coming in is going to really be more focused on controlling rates.
So what do you want to do with your money right now, Adam? I mean, do you want to stick with those companies paying dividends? Do you want to go with the cyclical names that are very sensitive to economic growth? How do you play it?
So it's basically balanced, right? We have, in mid-April, we said, let's take a shot at some of these cyclicals because they've gotten so cheap. But I don't think the dividend trade's over. I don't think it's over. I don't think bond yields are going to back up so much so fast. You can still buy a basket of U.S. equities that dividend yields are above the 10-year meaningfully that are going to grow.
On your book, what does happen when the music stops?
Well, bond yields back up. Equities might take a big hit if, this depends on the numerator, right? If the economy's looking great, equities will be good. There is this denominator, which is the interest rate used to discount earnings, and that's going, there's no doubt that that's going up. And the Fed is going to try, with limited weaponry, unlike other times, to achieve a soft landing.
Right. Gentlemen, thank you very
Pleasure.
much. Alan Blinder, Adam Parker joining us. We so appreciate your time today. Thank you. Up next on The Money, my one-on-one with the Speaker of the House, John Boehner. He talks candidly about Fed policy, the economy, immigration, and a lot more. Plus, the one issue that's got him all fired up.
I can say the sun's not going to come up tomorrow, but guess what? It is.
And as we take a break, take a look at how the stock market ended the week. Back in a moment. Welcome back. House Speaker John Boehner, a man under a microscope. Republicans recently failed to pass a farm bill that was expected to go through. His leadership is arguably being challenged in the House, and everybody's watching and waiting to see what will happen with the crucial immigration measure. I sat down with him this week, and we talked energy, Ben Bernanke, and the markets.
The sell-off is in large part due to the policies that we've had coming out of the Federal Reserve. You know, you can't continue to deflate our money and deflate it and deflate it, have the equity markets go up without some change. Now, Bernanke has made it clear he's doing these policies in the absence of the government doing its part to help improve our economy. That's why Democrats and Republicans here on Capitol Hill and the president need to deal with fix our tax code that would help us promote more economic growth and deal with our long-term spending problem.
But how likely is that over the next year? I mean, Bernanke made it clear that if the data continues as it is, then they could be out of the bond buying business by next year this time. So that's 1 year. Will we see fiscal policy in terms of tax reform, in terms of regulatory clarity? Will we see that in the next 12 months?
Well, listen, hope springs eternal in my heart. And while we have big differences over what tax reform might look like, what entitlement reform might look like, we have to come together and to deal with these things.
How do we tap into the rich assets that this country holds? Is there any likelihood that we actually see Keystone approved, fracking developed?
When it comes to energy, we need the Keystone pipeline. You know, we've got 9 100-unit tank trains that leave North Dakota every day. And many of those go to the Gulf Coast. While they can do that safely, it'd be much more efficient if we built the Keystone pipeline. All the president has to do is say yes. When it comes to the threat coming out of this administration that they want to regulate fracking, the states do this, and the states do a very good job. We don't need the federal government getting in the way. But the federal government here has shut off almost all federal lands to more oil and gas development. All the expansion that we are seeing is all happening on private lands. We need the federal government to work with us to open up the Intermountain West, to open up the Outer Continental Shelf where there's tremendous resources. We've got more resources that's beginning to appear than almost any country on earth. Why wouldn't we develop those resources for the betterment of the American people?
The people that I speak to, they agree with you on economics. They are fiscally conservative, but they are socially liberal. They believe in gay marriage. They believe in a woman's right to choose. And they feel that you've let them down.
Well,
the GOP has let them down.
Well, listen, after the Kermit Gosnell trial in Philadelphia and some of the horrendous things that were going on, I think passing a bill to ban late-term abortions was the appropriate thing to do. We can walk and chew gum here. Our number one focus continues to be on the economy.
How are you going to get those people back that feel that the GOP has let them down? What do you need to do to lead this party into the next century?
What I tend to do is to work on things and talk about things that unite us as a party. And typically it would be economics. It would be over the size and scope of government, rules, regulations, a tax code that nobody understands. Those are the things that unite us. Those are the things that we must remain focused on.
Let me ask you about the debt ceiling. More worry on Wall Street that we could see a government shutdown over this and another major fight on the horizon. White House officials that we've spoken to on background say that the president will not negotiate on the debt ceiling again, period.
Well, you know, I can say the sun's not going to come up tomorrow, but guess what? It is. So the president can say, I'm not going to negotiate on the debt limit. Get over it. We're spending more money than what we're bringing in. We have to deal with this problem. And if we're going to raise the debt limit, then we've got to do something about what's causing us to spend more money than what we bring in. So guess what? We're going to have a debate and we're going to have a negotiation.
You think we will see this be dealt with by the end of the year?
I would certainly hope so.
Let me ask you about immigration. A lot of people hope that we can get something done there. You've said that you won't move a bill on immigration on the House floor without a majority of GOP support. Why?
Well, I think big issues here in our country need to be done in a bipartisan, bicameral basis. And what I said was that we need a majority of both parties to work together in a constructive way to deal with our broken legal immigration system and the problem with illegal immigration. But nothing's really going to happen until we're able to secure our borders.
We all know that there was a challenge to your speakership earlier this year after the tax hikes went through. Some in your party are predicting another challenge because of this immigration bill. Are you worried?
No. I fully expect to be speaker. You know, as a speaker, I take a lot of hits. I get a lot of hatchets thrown at my back every day. Listen, it comes with the territory. And if you're going to lead, here in Washington, you know, you're going to take some hits.
My thanks to John Boehner. Up next on The Money, wealthy baby boomers are leaving the suburbs as they enter retirement, but they're not flocking to Florida's Gulf communities like you may think. So where are they headed? Find out next. And I hope you'll look for us on Facebook/Maria Bartiromo. All right, welcome back. Thousands of baby boomers hitting retirement age every single day, and many of them are looking to downsize and move to new places for the next stage of their lives. But where is the over 65 set choosing? It's not choosing to live in your typical retirement community anymore. Joining me right now with the new hot spots for seniors is the Rise of the Creative Class Revisited author and the Atlantic Cities co-founder and editor-at-large, Richard Florida. Richard, good to see you again.
Great to be here, Maria.
Thanks so much for joining us. So this month, you write online in the Atlantic Cities. You wrote about how today's retirees are not moving to golf communities anymore in Florida. They're not going and putting their feet up on the hammock. So where are they looking to retire?
Well, it's interesting. We organized this forum with the AARP, you know, who clearly know a lot about this, and we dug into the research, and what we found is, of course, the baby boom is aging fast. I'm a member of it. We're adding 10,000 people a day to this over 65 cohort. There's about 40 million of us, and what's really interesting is, of course, some people are going to the traditional fun in the sun golf communities, but more and more and more these baby boomers are looking at bigger cities. New York, San Francisco, the Bay Area, Boston, Seattle, and then the other places, the college towns. These really interesting college towns are places they're really looking at as they move out of the workforce or maybe into a new career when they're quote-unquote retired.
So they want action.
Yeah, I think what happened is, in the old days, you know, you worked at a factory or you worked an office job, same company for life, and when you retired, you wanted to chill out. I think for many of these people who had more knowledge-based careers, they're looking for a couple of things. Of course, they're looking for nicer weather, and places like Naples or Palm Beach and even Miami are still or Santa Barbara in California. But they're looking for places that have great health care. I mean, we can't minimize that. You know, if you're over 65, one of the most important investments you want to make is in your health and well-being. But they also want a place that offers a lot of amenities. You know, and maybe it is some golfing and theater, but it's great restaurants, great cafes, great food. They don't want to cook a lot. They want to go out to eat. And also, the other thing is being close to their kids. And where are their kids going?
Yep.
Big cities.
Right. So in the article, you say there are 10,000 baby boomers turning 65 every day, and that they continue to be active. They're wealthy as a group as well. And so there's got to be an economic impact, right? So what's the economic impact on cities from baby boomers moving in?
Well, on the one hand, for a city like New York or San Francisco or Minneapolis or Pittsburgh with good health care, that is also one in our categories, the best buy is Pittsburgh for an aging baby boomer, new retiree. The impact on the city is great. They don't bring kids who are in school. They don't demand a lot of services. They pay for health care. But the problem that we see, and we talked about in the forum, if older baby boomers are coming into town downsizing from a big house to an apartment, they can buy that apartment cash. How about the young kids coming in looking to start their career in New York or San Francisco, be part of that tech startup, be part of the financial markets, be part of the media? I think it puts a lot of pressure. I think one of the things driving the housing affordability problem, of course, the global people are coming in, but it's also the baby boomers coming back to the city.
Is there a negative impact on young families, on single professionals then?
I think it's making it harder for younger people and young families. You know, you're competing against a 55 or a 65-year-old who worked their whole life and have saved a little money or have a house they can pull it out of. You're coming into a city, you want to buy a place or rent a place, it's driving prices up. So for the city, the baby boomers coming back is good, but it puts a lot of pressure on the housing market, may make it harder to attract that young talent that's going to drive the city's economy in the future.
That's interesting. So if the baby boomers are moving into urban areas, what do, you know, like where the younger people are, what happens to the retirement communities? That's also probably getting impacted.
Yeah, we don't see a lot of demand for retirement communities moving forward. And it's interesting, you know, one of the things I've been noticing is a lot of the people who used to develop retirement communities are now developing, you know, urban loft community. But it's not just in the big cities. I said this before. These great college towns, Madison, Wisconsin, Ithaca, New York, Ann Arbor, Michigan, which have great health systems. You know, they usually have university medical centers, they have restaurants, they have activity. So it's not just big cities, it's towns that have great health care and a lot of things to do.
Really interesting stuff. I mean, you're really seeing a shift across the country. Richard, great to talk with you.
Thank you. It's
Thanks
great to be
so
here.
much. Richard Florida joining us. Up next, a look at the news this upcoming week that will have an impact on the money. And then the president got his wish. Jack Lew made a major change now that he's the Treasury Secretary. Find out what it was next. Stay with us. For more on our show and our guests, check out the website, otm.cnbc.com. And I hope you'll follow me on Twitter and on Google+. Look for @Maria Bartiromo. First, though, here's a look at the stories coming up in the week ahead that may move the markets and impact your money this week. On Tuesday, new home sales for the month of May will be out. Also on Tuesday, the Conference Board will release its Consumer Confidence Index for the month of June. On Wednesday, we get the third estimate for the first quarter's gross domestic product. That's typically a market mover. Also on Thursday, personal income and outlays are reported for the month of May. And on Friday, Wall Street will participate in a simulated cyber attack drill called Quantum Dawn 2 that was organized by the trade group SIFMA. And finally today, who knew legible penmanship was a must for a Treasury Secretary? Jack Lew's loopy, hard-to-read signature underwent a major transformation since President Obama joked about it during Lew's nomination earlier this year, you may remember. The Treasury Department revealed his new, clearer signature on a $5 bill this week, which will be in circulation this fall. Oddly enough, Lew isn't the first Treasury Secretary to change his John Hancock. His predecessor, Tim Geithner, also changed his signature before it was on bills. That'll do it for us for today. Thank you so much for joining me. Next week, I will be headed to Aspen. I'll be reporting from the Aspen Ideas Festival, where I'll be talking to movers and shakers from the worlds of finance, politics, and arts. Hope you'll be with us as well. Each week, keep it right here, where we are on the money. Have a great weekend, everybody. Happy first day of summer. I'll see you next weekend.